Getting ready for the big show. Happy Monday. All right. Thank you for joining me. I'm Mitch Goldberg. This is your post-market live show. We go over the day's events in the stock market, the economy, the big news that affects you. We talk about the intersection of Main Street, Wall Street, and Pennsylvania Avenue. I like the way that sounded. We talk about personal finance, financial planning, investing, some of the mundane stuff, some of the exciting stuff. But the whole idea is to help you take control of your money. That's why I call the show Be the Boss of Your Money. Inflation is the big deal. It's the buzzword. It's all anyone can talk about. So why not us? Let's take a deep dive into inflation in terms of what to do about it, maybe change your investments, maybe not. What investments could do well, could do poorly in terms of a high inflation environment, and some other things in personal finance that you should be doing. So I've got a really good show. I put some thought into this. Look, I always put some thought into it, but today is definitely a run and gun show. So what we're going to do is we're going to roll the intro, and then we're going to get into some good things. While you're watching, if you have any questions, definitely ask me in the comments. I love hearing from you. And let me know where you're watching from. Give me a thumbs up or a heart or a celebration, icon or response, depending on what platform you're watching from. And here we go. All right, we're just getting started. If you're joining me now, I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money. Couple of things to talk about. But the big topic is in inflation. It's like a tongue twister. The big topic is inflation. That's the big topic. Inflation is the word of the day. It's all anyone can talk about. And it's not something that seems to be subsiding. In fact, talk about inflation is picking up. And now the rest of 2021 with the market up, and we've been talking about could the market rally into year end. We've been talking about all these things and high flyers and tech stocks, et cetera. But it's the 15th of November. So we've got a month and a half left. You strip out the holidays, Thanksgiving. It's really not a lot of active days left for this year. So inflation is all anybody could talk about. And we are definitely going to talk about inflation because it's such a big topic and it's what you want to know about, okay? I see a few people out there. And hey, by the way, Rhonda, nice to see you. I haven't seen you here for a while, so it's really nice to see you. Thank you very much. Rhonda from Setauket. I feel like a talk show host. We're talking with Rhonda from Setauket. Thank you very much, Rhonda. I really appreciate you joining us. It's me and you, you and me. Da, 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 da. That's a throwback to the 80s, right? Da, 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 da. Okay. So anyway, I'm not going to waste your time with my singing. I'll just waste your time with talking about inflation a little bit more. We need to get into this. So we're going to do a quick market breakdown, and I think this will be a good segue into inflation. So let me pop myself up into the screen. Dow off 12 points, no big whoop. NASDAQ down 7 points, no big whoop. S&P basically unchanged. I mean, the Dow and the NASDAQ are off by 0.04%. The S&P is basically unchanged. Gold is down 0.2%. Oil is up 0.24%. Who cares? The 10-year Treasury barely budged. This is about as quiet of a day as you get. That's why I titled today's live stream. Okay, I titled it Stocks pause on inflation outlook. The VIX barely budged 16.49. Look, it's under 20 is what we are looking at. Um, Russell 2000 was off barely. This is about as quiet of a day as I've ever seen. This is like the day before Thanksgiving. There's just nothing going on. And it's very strange. It's kind of unusual to have a day as flat as we had today. So let's celebrate that. We'll celebrate a flat day. All right. And let's talk about inflation. So inflation is a persistent rise in the costs of goods and services. Now, when does it actually become a problem where it becomes ingrained in people's minds, when it's maybe no longer, when it's no longer considered transitory by market participants, by consumers, by businesses? For one thing, when consumers and businesses start to order goods well in advance of needing them because they're trying to beat out price increases, that in and of itself creates even more inflation because demand starts to surge for goods. Think about what happened with things like toilet paper and Clorox wipes and cans of Lysol when we started getting into the pandemic in 2020. People started ordering and ordering and ordering. Prices went up, and then we had shortages. And that can happen with a lot of things. So that's one thing. When businesses when businesses start to plan their budgeting and their projects in the next quarter, in the next year or 2 years, and they start figuring out that they have to order now in order to beat price increases, that's when inflation really starts to set in, and it becomes a self-fulfilling prophecy. And it just makes prices go up more. And the more prices go up, the more people start to order in advance and hoard things. Because if you wait, prices keep going up and you'll just pay more. It's kind of like deflation when you don't want to hold any inventory because whatever inventory you have is going to be worth less very quickly. All right. So it's the opposite of deflation. Obviously, it's inflation, and businesses start planning price increases. They start to say, hey, we're putting X amount of product into a 12-ounce can. We don't want to raise the price, so let's just give people an 11-ounce can of the same product for the same price. So you'll start to see products that you buy shrink in size. The price will stay the same. So at least prices didn't go up, but you're getting less for your money. So in that regard, on a per unit basis, things just become more expensive. So that's another thing with inflation. Now, there are a couple of what else should you know about inflation? When we have high inflation, typically interest rates go up. So bonds that are traded in the market typically become worth less. So let's say a bond is 100 cents in the dollar. Maybe it should go down to 95 cents in the dollar or 90 cents on the dollar. So if people are holding, let's say safe, I'm doing air quotes if you're not watching this, if you're just listening to this, if you're in safe air quotes bonds, they could go down in value, and then you have to hold on to the bond until maturity to get your principal back. Or if you sell it before maturity, let's say you paid 100 cents on the dollar for a bond and now it's 90 cents. So if you sell it now, you lose money, so you might want to hold on to it. But the point is the bond's getting marked down because the interest they pay is worth less money in an inflationary environment. For example, if you're getting 1% from a bond and inflation is 1%, you're breaking even in real terms. But now if inflation is 5% and you're earning 1% on a bond, you're actually, in real interest rates, you're losing 4% annually on your money. So therefore, the bond has to drop in price until that 1% becomes 5%. So the bond has to go maybe down to 90 cents. Okay. And that's what I mean by bonds going down. What else? High valued stocks, highly valued stocks, stocks with high PE ratios also typically go down in a rising rate environment. Now, why is that? Because when you have a stock with a high PE ratio, price to earnings ratio, it's not the be all and end all of valuations, but I think I'm doing air quotes again, the PE ratio is considered to me, the most popular valuation metric out there. I actually don't pray at the altar of PE ratios. I think there's a lot lacking with PE ratios. Uh, PE ratios are earnings after all the taxes and accounting gimmickry. It doesn't really tell you cash flow, but anyway, PE ratios are PE ratios are a very commonly used valuation metric. So when we have a PE ratio valuation metric that's very high, let's say the market's trading at 20 times earnings, but a stock is at 80 times earnings, it's because we expect that company's future earnings to be so good and worth so much. As investors, we're willing to pay up for the stock 80 times instead of 20 times for the market. So it's literally a 400% valuation difference. Now, if inflation goes up and then that drives interest rates up, what often happens is that the high P ratio stocks earnings that we expect to be so great in the future are all of a sudden worth a little bit less, sometimes a lot less, if interest rates today go up. So that's another thing that often gets hurt. But we're seeing a lot of cross currents right now. Even though the 10-year treasury yield is about 1.6, 1.62 in that range, let's say in the 1.6s, considering we have about 5% inflation, we just had an inflation reading that's the highest in 30 years. You would think the 10-year yield would be like 6% right now. And if it did jump to 6%, my sense is, and I think this is, I think most people will agree with this, the stock market would get crushed, like just a massive revaluation to the downside. But the 10-year treasury is not going up. And there are a lot of technical reasons for it. There are a lot of fundamental reasons for it. But that is a very big concern, that interest rates could start to go up, which would hurt high-flying stocks. Okay, so if you are a long-term investor like me, the idea is not to take your whole portfolio and just throw it in the garbage. The idea is to take stock, no pun intended, of what you have and make sure that you are comfortable with the portfolio you have, and really make sure that you have the time horizon, long-term time horizon, to wait in case we have a brutal bear market and interest rates do rise a lot. And I think that's the missing ingredient here. I spoke with a journalist and friend at CNBC today, and we talked about inflation. And her first question was, with people so used to low inflation and low interest rates, like could people be caught off guard? Could they be shocked by higher interest rates? And I said, yes, but people, it takes something shocking to knock one out of complacency. And that's kind of a shame. So if I say to you, you really need to make sure you know what you have, and you need to make sure that you are committed to the investments you have for the long term, because we could conceivably go into a pretty bad bear market, not one that lasts like 6 weeks, but one that could last years. And for a lot of people, that would be a big setback. Now, for a lot of people, that would be a buying opportunity. So this is not blanket advice. You're 20, 30, 40, even 50 years old, 55. Okay. These are buying opportunities because you've got a long runway ahead of you. If you're close to retirement or in retirement, this could crush you. This could literally crush your retirement plan, your lifestyle. So the things to do in case there is some of the things to do in case there is a lot of inflation, if inflation remains high for a persistently long time. We'll get into the definition of a long time right now. I'm thinking 3, 4, 5 years. Some of the things that you should do is this: refinance debt. So if you have a mortgage and you haven't refinanced it yet, yes, there are people out there who haven't refinanced. Refinance now while interest rates are low, because if interest rates go above your mortgage rate, it's almost like getting paid to stay in your house to pay your mortgage. So you want to refinance debt. You also want to prepay things. So, for example, college funding, a prepaid college plan now would be a great asset to you if inflation were to rise substantially, because you're locking in today's prices for college costs in the future. And we all know that college has risen much faster than the overall rate of inflation, than the overall national average inflation rate. I know this might sound morbid, but even prepaying, oh, this is going to sound so morbid, but even prepaying things like funeral expenses in today's dollars, because funeral expenses will be going up. Anything that you could prepay in an environment where inflation is rising is, generally speaking, for personal finance, a good way to go. Now let's talk about hedging. I really think that for most investors, like the overwhelming majority of retail investors, hedging your portfolio for inflation does not make sense. I don't think most people could really put enough money into hedges and risk that money in hedges. Hedging is actually pretty risky. Typically, instruments people use to hedge, like futures and options, most investors lose money on this, retail investors. So these things are pretty tricky to use, and I don't advise your typical average everyday investor to use those instruments. These are more for professionals who do nothing but watch this stuff. All right, these who watch the market. So my way of hedging is this, and what I'm going to say as a lower risk hedge. There's nothing that's risk free, but what I would say is, if your allocation in stocks and if your investments are so large for your net worth that you have very little in cash, any cash that you need, you could choose your own time horizon. I'm just going to throw this out there as an example. Cash that you need in 2 years, some of you for 1 year, some of you for 3 years, but your cash obligations coming up should be out of the market, okay, and in just cash. Because if inflation rises quickly, the pace of inflation stays high, and the stock market takes a beating, the money that you were going to use to pay for your financial obligations, which is now in the market, will become less. So you'll have to sell even more shares of your mutual funds, stocks, or exchange traded funds in order to pay your financial obligations. That's not something you want to get into, because you get into something called the negative sequence of returns. It just means that because you're selling more shares now, that when the market, it just means that you'll be selling more shares for the same amount of money if the stock market goes down. What that means is it makes it harder to catch up when the market recovers, because you have fewer shares working for you in the market. So you want to take money off the table, put it into a savings, checking account, what have you, cash equivalents. Yes, I realize that those are a surefire way to lose to inflation when inflation is 5%, for example, and you're earning practically nothing in a checking account or a CD or a savings account. I get that. But we're talking about preservation sometimes, and when you talk about preservation of capital, it's not the return on your money we're talking about, it's the return of your money. And there's a big difference. It's not so subtle Okay, you're using of instead of on, return of your money instead of return on your money. So what else could you do if we do have inflation? Now, people do want to do think, like, well, you should get into gold or crypto or some other assets that do well in times of inflation. So I want to tell you that gold and crypto and other investments, for example, the common stock of commodities producers, energy producers, those move up and down for many reasons. Inflation is a big part of the story, but it's not the only reason. Gold is net down at this moment. Gold is down in 2021, which is surprising considering we've got the highest inflation now in 30 years. So gold really isn't acting like a great inflation hedge. Maybe gold is telling us that inflation really is transitory. I'll get into that in a moment. And then people say crypto is where you want to go now as your inflation hedge instead of gold. But the thing about crypto is crypto, I think, is going up more because it's becoming more broadly adopted by investors. Okay. Demand for crypto is going up because people are enthused about it. They see it going up. So other people want to get into it. That's what's driving crypto. And I realize that there are a lot of uses for crypto and the uses are expanding every day. And I get that. But the point is that is crypto is going up more because of broad adoption as opposed to just an inflation hedge. Okay. So my view of an inflation hedge investment is to own a good company with a solid dividend and a below market PE ratio. Those three characteristics, okay, actually typically help you withstand inflationary weight on the stock market. I mean, what are you going to do? Move your whole portfolio into gold and crypto? Having a 1 or 2% allocation to gold is not going to really move the needle for you if we have a generally down stock market because of generally persistent high inflation. And then the Fed starts to raise rates, which makes the stock market go down more, which could make the stock market go down more. A little bit of gold, a little bit of crypto, a little bit of oil stocks or commodities producer stocks are probably not going to help you enough to offset all the risk in your portfolio. So, for the purposes of diversification, I think there's a place for them for the right client, not necessarily for everybody, because commodities producing stocks are typically very volatile. They're not, widow and orphan stocks, as we used to call the blue chips. Okay. But a high, dividend yield that's solid and steady, lower than market P ratio, those help. Those help a lot. Those are low duration stocks. So I don't want to see you making giant moves in your portfolios. The really, to me, the best way to hedge risk in your portfolio is to make sure the money you need in the next few years is not in the stock market. To me, that is another way of hedging, and I think it's a boring, lower risk way to hedge, as opposed to going into gold or crypto or buying an energy stock like a Chevron or something, and those could go down a lot. And then what good was your hedge? Look, remember what I said at the top of the show here. Hedging presents its own risks. There's reason to believe that hedging lowers the risk of your overall portfolio. But if you don't really know how to hedge, you risk your overall portfolio going down, plus losing money on your hedges as well. And that is a really bad position to be. So I think for your ordinary investor, like my clientele, putting cash aside is really a much more appropriate way to hedge risk. I hope I'm helping you with your understanding of how inflation could affect you and whatnot, and what you could do with your portfolio and your personal finance. So that is what I've been talking about to clients constantly, and I've been talking to the media about it. And that's my story, and I'm sticking to it. I know that for most of my clients who are long-term holders, we're not really making big changes. We're not changing entire portfolios and reconfiguring someone's entire retirement account because, well, now everything's different because of inflation. What we're doing is we're making sure the time horizon is correct. We're making sure the allocation between stocks and bonds is correct. And that's the best, really, what we could do. Who's to say inflation goes up? Now let's talk about the last thing is transient. Is inflation truly transient? The Federal Reserve has been saying inflation is transient. Some of it is, some of it's not. I mean, minimum wage going to $15 per hour is not transient. We're not going to suddenly say, hey, let's pay everybody $13 an hour instead of 15. Wages don't go down. They might stay flat, but they typically don't go down. What could be transient is as the supply chain disruptions all over the world start to correct themselves with a supply response, okay, that would you would then see inflation go down for products. Things that you buy could go down, but the people who are working at the stores are probably not going to get paid less. And I know a lot of people want to blame so many things, but the inflation we're having with the supply chain, this has been on its way for a long time. And finally, something broke. COVID was the spark for that. We'll get through it, but it's not going to be a one-day event. It's not going to be like one day, oh, everything's fine now with the supply chains. Global supply chains are fine. Everybody's up and running. All the ships are unloading their stuff in Long Beach and LA. And, the trucks are moving. The rails are doing great. It's going to be a very slow, tedious, gradual process that could take a year, 2 years, or 3 years. When you get to that long, it's hard to argue that inflation is transient. I mean, if you think about it, in like a billion years, the sun's going to explode. So I guess we're all transient here. Let's talk about human life. Few years is not transient, but we'll see. So we're at the point now where we're not talking about, by the way, just so you know, is inflation transient or not? We're talking about which parts of the labor and materials markets are going to be transient, and which parts are going to be sticky as far as price increases go. And again, when consumers and businesses start to factor in price increases in the future, they start to hoard things. They start to pre-order. They start to stock up on inventory, and that creates even more demand, which creates higher prices. And with the supply chain disruptions, it could cause prices to spike pretty rapidly, even more so than what they've been doing. But these are all up in the air, and that's why it is just it's so tough to tell. Phil is out there. Good show today. Inflation will not be transient with current policy in place. It's tough to say, but I am always amazed that regardless of different policies, somehow the U.S. economy always rises to the challenge. I just hope it rises to the challenge before we all get dinged severely in our net worth. That's it for today. Thank you so much for watching. I'll be back tomorrow. And if you think of any other questions or anything else you want to add to it, and thank you very much, Rhonda and Phil, for joining me today. You let me know. We're just about at that time, just about a half hour. So I'm going to get going, and I hope you all had a wonderful weekend. Thank you.